My name is George Chevalier, and since 1987 I've been helping families buy homes when they didn't have the money to pay for it by providing home mortgage financing. One of my favorite things about my job is that I get to help families every day obtain home ownership. You know, loan guidelines are changing every day. If you would like to learn more about the world of home loan financing, please keep watching.
One of the best reasons to refinance is to lower your current interest rate on your existing loan. Knowing whether to refinance comes down to answering a few questions. Number 1, how much can you save on your monthly payment? Number 2, how long will it take to recoup the cost of refinancing? And number 3, do you plan on taking cash out to pay off debt or remodel your home? When you refinance a mortgage, you take out a new home loan with new loan terms. The new loan pays off your original mortgage. Many homeowners choose to refinance to get a lower interest rate or monthly payment to free up room in their budget, to shorten their loan term, which reduces the interest they pay and can help them pay off their loan faster, to switch from an adjustable rate mortgage or ARM to a fixed rate mortgage so that their monthly payment is fixed, to pay off credit card or other debt, or to remodel their home. Refinancing a home can be a smart financial move, but you need to take time to evaluate your situation before you jump into refinancing. Here are some top things to consider before you refinance. The first thing you'll want to consider is how much interest will you pay. Cutting your interest rate can help you pay less interest over the life of a new loan compared with the remaining term of your original loan. However, even with a lower monthly mortgage payment, you could be paying more interest over the long term by stretching out your new loan term. You could calculate how much interest you would be paying on both loans and compare the amounts. If it makes sense for you to refinance, especially if you're going to be lowering your monthly payment, then it may be a good time for you to refinance. What's your current interest rate? If you don't know what your current interest rate is, you can find it by looking at your monthly mortgage statement. Some mortgage experts recommend refinancing if you can slash your interest rate by at least 3/4 of a percentage point. You'll want to contact a licensed mortgage professional and ask for an estimate of your interest rate. You'll also want to know how much you can qualify for a new loan, as well as what your new monthly payment and closing costs would be. Then, calculate what your potential savings might be. You'll want to consider how long will you be in your home. Even if you're able to lower your interest rate and monthly payment, refinancing might not make sense if you're not going to be in your home for the next year or two. It's going to take some time to recoup the cost associated with refinancing your home, and if you plan on moving soon, you won't have time to recover the cost of refinancing. If you have 21 years left to pay off your existing mortgage and you get a new 30-year mortgage, you've just added 9 more years of paying a mortgage before it is paid off. You may want to consider getting a loan for less than 30 years. If you can lower your monthly payment or even keep your payment the same but pay your mortgage off faster, you could be debt-free sooner. These are all things to consider when refinancing your home. Next, you'll want to consider how much equity you have in your home. Over the past few years, values have increased, which means for many homeowners, you may have built up equity in your home. Your equity is the portion of the home that you own and is calculated by subtracting the mortgage balance, that's what you owe on your current mortgage, from your home's market value. For conventional mortgage refinances, you'll need to have at least 20% equity in your home to avoid paying for private mortgage insurance. Next, you'll want to consider closing costs. Your mortgage professional will be able to tell you what your closing costs will be to refinance your mortgage. The cost to refinance a mortgage will vary according to your interest rate, credit score, loan amount, and of course the lender you choose. The closing costs of a home refinance generally include credit fees, appraisal fees, points, which is an optional expense to lower the interest rate over the life of the loan, insurance and taxes, escrow and title fees, and lender fees. If you have enough equity in your home at the time of refinancing, you may choose to finance your closing costs and fees by adding them to your mortgage balance. You may also decide you want to take some cash out of your new mortgage. This cash may be used to cover your closing expenses. Don't be fooled by an advertisement of a no-cost mortgage. There is no such thing. A no-cost mortgage does not mean that it costs you nothing. With a no-cost mortgage, you will have the cost of a mortgage tied into the interest rate, which means you could end up with a higher interest rate. Be sure to check with your licensed mortgage professional to find out your refinance options.
I'm George Chevalier, and I help people buy homes when they don't have the cash to pay for it. If it's your first home, your next home, or your rental home, my team and I will be sure to make sure that you have the right financing in place and ensure a smooth and easy process. Thanks for watching. If you would like more information, give me a call or shoot me an email. My contact information is below. We look forward to helping you reach your real estate goals.